Welcome to lecture number 29. In this lecture we shall discuss about cash flow from financing activities. In this section of the cash flow analysis module, we shall look at the cash flow from financing activities of the borrower. We shall refer to this as CFF. In cash flow from financing activities, the company's liability is the source of fund. When a company raises liability, A. There is an inflow of cash. B. The increase in liability will result in cash inflow in the financial statements and is the source of cash inflow. C. The cash outflow from financing activity would be 1. Liability repayment, in the balance sheet, or 2. Finance charges like interest or dividend payment, in P&L. Let us look at these in more details. We shall now look at the method of calculation of the cash flow from financing activities or CFF. In cash flow from financing activities, the calculation is done for change between 2015 and 2016 in our example. Thus CFF is calculated as the sum of all the highlighted items in the liability side of the balance sheet, minus the items highlighted in the asset side of the balance sheet. Sum of the liability side items equals increase or decrease of paid up capital or equity. Reserve, excluding PAT for 2016. Unsecured loan, term loan. Advance from customers. Other current liabilities and bank borrowing for working capital. All these items are marked in green on the liability side of the balance sheet. Please note, while calculating the cash flow from operating activities, we have already taken PAT as inflow, so we have to deduct PAT from increase in reserves to find out any increase in cash flow from financing activity on account of increase in liability. The items to be deducted from the first part are the sum of the items highlighted in the asset side of the balance sheet, the sum of increase or decrease in advance made to suppliers. Please note that advances to suppliers and from customers can be considered operating activity. However, if it's a loan to supplier, investing activity, or loan from customer, financing activity, it has to be treated accordingly. In this session, for sake of simplicity and to provide a perspective, we are netting off these entries in cash flow from financing. We shall finally deduct the financing charges incurred during the year. Finance charges or dividend payment to be found in P&L. Finally, the cash flow from financing is calculated as CFF equals A, sum of items on the liability side of balance sheet, minus B, sum of items considered on asset side of balance sheet, minus C, financial charges incurred during the year taken from the P&L. Let us look at the CFF calculations from the balance sheet. The balance sheet is shown for the financial years 2014-15 and 2015-16. First, from the liability side of the balance sheet, we shall calculate the change in equity and reserve. Equity equals rupees 40 lakhs on March 2016 minus 40 lakhs in March 2016 equals 0 or no change. Reserves equals rupees 60 lakhs plus 9 lakhs plus 53 lakhs in March 2016 minus rupees 40 lakhs plus 10 lakhs plus 23 lakhs in March 2015 minus rupees 53 lakhs as PAT in 2016 already accounted as inflow in operating activities, thus reserves equals minus 1 lakh. Next we look at the change in unsecured loans and term loans. Unsecured loans equals rupees 50 lakhs plus 30 lakhs in March 2016 minus rupees 30 lakhs plus 20 lakhs in March 2015 equals rupees 30 lakhs. Term loans equals rupees 70 lakhs in 2016 minus rupees 60 lakhs in 2015 equals rupees 10 lakhs. Finally, we look at the change in current liabilities. Advances from customer equals rupees 5 lakhs in 2016 minus 10 lakhs in 2015 equals minus 5 lakhs. There is a reduction in advances from customers. Other current liability equals rupees 20 lakhs in 2016 minus 15 lakhs in 2015 equals rupees 5 lakhs. Bank borrowing for working capital equals rupees 45 lakhs in 2016 minus rupees 35 lakhs in 2015 equals rupees 10 lakhs. Cash flow from financing from a liability side of BSR cash inflow to business. Let us summarize the calculation so far. Total of the liability side cash flow from financing equals capital plus reserves equals rupees minus 1 lakh. Unsecured loans and term loans equals rupees 40 lakhs. Current liabilities equals rupees 10 lakhs. Total equals rupees 49 lakhs. We shall see the calculation of the asset side for cash outflows from the balance sheet in the next slide. Now we shall look at the cash outflow to business from the asset side of the balance sheet and the P&L statement. The items to be considered are change in advances to suppliers and finance charges incurred during the year. The finance charges are taken from the P&L. First, the change in advances to suppliers. From the balance sheet, we can see rupees 5 lakhs in 2016 minus 5 lakhs in 2015 equals 0 lakhs or no change. Next, the finance charges, which are primarily the interest paid on loans. The company has paid finance charges of rupees 15 lakhs in the course of financial year 2015-16. Since it is a P&L item, absolute amount is taken. The net cash flow from financing activities CFF calculated by inflow minus outflow equals rupees 49 lakhs minus 0 lakhs plus 15 lakhs equals rupees 49 lakhs minus rupees 15 lakhs equals rupees 34 lakhs. The business has a net inflow of cash flow from financing. Click on the cash inflow button to see the detailed calculation. Thank you for watching this lecture.